Today was a rough day for the stock market. The Nasdaq plunged 3.5% and the S&P didn't fare much better. So, what triggered this crash, and what does it mean for investors? The Fed's recent release of meeting minutes has everyone on edge, hinting at more aggressive interest rate hikes to combat inflation, an admission that they've underestimated the situation. Since last November, the Fed's policy has been increasingly criticized for not tackling inflation as seriously as needed. Now, they're starting to admit that they'll need higher interest rates than initially projected. Wall Street wasn't ready for this. The Fed's statement spooked the market, triggering a sell-off as investors braced for a period of higher costs and lower growth. I've been cautioning for over a year that the Fed needed to get more aggressive on inflation. Many hoped inflation would be temporary, but today's numbers are showing just how persistent it's become. This isn't just a one-time hit. The Fed's acknowledgement marks the beginning of a larger shift. Investors who went all in too early may be facing harsh losses, while those with cash on the sidelines could find some real buying opportunities soon. So why did the market react so intensely today? The Fed's minutes indicated a likely increase in interest rates, which implies more significant borrowing costs, impacting companies' earnings and growth prospects. This is similar to the tough measures taken in the 1980s under Paul Volcker, who hiked rates to tackle inflation, eventually bringing economic stability. But do today's policymakers have the determination to follow through? Then there's the issue with Jim Cramer's recent conflicting advice on the Chinese stock DiDi. First, he recommended it, then reversed his stance, calling it a risky move under China's strict regulatory environment. His back and forth reflects how unpredictable markets have become and highlights the need for caution, especially when listening to media-driven hype. But back to the U.S. market. With inflation rates persistently high, many analysts suggest we're staring down potential double-digit inflation soon. If inflation stays this high, using the traditional 1.5x rule suggests interest rates may need to climb to around 15% to effectively curb it. This, however, isn't realistic given the debt the U.S. carries. Higher rates would increase borrowing costs drastically, making debt service nearly impossible without printing even more money, adding more fuel to the inflation fire. This leads to a vicious cycle where inflation and high interest rates feed off each other, trapping the economy. To avoid this trap, the Fed needs to do more than raise rates. They must address supply chain issues, end quantitative easing, and get serious about economic growth. The roadmap for a solution is there. It was done in the 80s. However, today's government may not be as willing to implement these tough measures, considering the political cost of triggering a recession to stabilize inflation. For those of us watching the market, this is an opportunity to wait for even better entry points. Personally, I'm testing the waters by buying a few stocks, but holding off on going all in until there's a more significant drop. Eventually, I think the Fed will have no choice but to hike rates even further, creating even better buying conditions. The U.S. economy isn't doomed, but decisive action is crucial. The challenge is whether policymakers will act quickly and risk their political careers to fix this. Without swift, bold moves, inflation could spiral, taking markets down further. Share your thoughts below, and let's discuss what moves we're making during these turbulent times.